When you're playing a massive open world video game, you never really stop to think about the physical servers running it.
Right, yeah, you just see this digital universe. It feels infinite and weightless.
Completely unconstrained.
Uh-huh.
You connect to the Wi-Fi and boom, the whole world is right there at your fingertip.
It feels like magic. But the grand illusion of the cloud is that it's somehow detached from physical reality, which, it obviously isn't.
Exactly, because if the server room loses power, or I don't know, the cooling fans break down and the copper wiring melts, that infinite digital world it hits a hard, unforgiving physical wall and vanishes.
And that collision between this infinite digital appetite we've developed and our very finite, very strained physical world, that is exactly what's defining our macroeconomic reality right now.
Welcome to the Deep Dive. Today is June 7, 2026. We're looking at a massive stack of institutional reports, macroeconomic briefings, and sector-by-sector equity analyses.
A lot of reading today.
A ton of reading. And our mission for you today is to basically map out the mid-2026 U.S. equity markets and the underlying macroeconomic environment.
Yeah.
We want to extract the key themes that you, as an individual retail investor, actually need to know.
And just to clarify, we are not giving financial advice here.
Right. No financial advice. We are simply providing a deep analysis of the tectonic plates that are shifting and impacting the economy right now, because we've permanently exited the era of zero interest rate financialized abstraction.
Yeah, the days of just throwing money at software concepts with absolutely no physical footprint are over.
Completely over. And to establish our baseline today, the market right now is being governed by three colliding forces: an AI-driven energy crisis, a totally fractured consumer base, and a sustained plateau in interest rates.
Which is a lot to cover.
It is. And before we get into the weeds, I need to make something crystal clear for everyone listening. The sources we're unpacking today, they contain discussions of highly politicized government actions.
Heavily politicized.
Yeah, things like protected trade tariffs,
Yeah.
federal deficit spending, the GPDS Act, and that really contentious transition of leadership at the Federal Reserve. So I want to be very clear. We are not endorsing any political viewpoints here.
Nope.
We are not taking sides. We are impartially reporting on these events strictly to analyze how they impact market dynamics. We just want to see where the capital is flowing.
Because honestly, the markets don't care about the politics. They care about the math.
Right.
And before we can even begin to understand where the money is going, we have to understand how much that money actually costs.
Which brings us right to our macroeconomic foundation, the velocity of real yields.
The cost of capital.
Exactly. The era of 0% interest rates is dead and buried. We are sitting on this higher-for-longer policy plateau. The U.S. 10-year TPS, that's the Treasury, inflation-protected securities at yield, has hit a devastating 2.17%.
Which is a massive number in this context.
Okay, let's unpack this. For the listener who doesn't spend their entire day staring at bond yields, what exactly does that 2.17% mean? And why is that specific number so lethal to the market?
Right, so a real risk-free rate of over 2% acts like this inescapable gravitational pull on all asset valuations. Let's break it down. TPS are bonds that adjust for inflation.
Okay.
So that 2.17% isn't your total return. That is your return above whatever inflation happens to be.
Wow.
Yeah. And it's essentially guaranteed by the U.S. government. So think about what that does to the corporate world. If you, as an investor, can get a guaranteed 2% real return just for holding government debt, the hurdle rate for taking a risk on a corporate venture becomes punitively high.
Like, why would I risk my money on a tech startup or some corporate factory expansion unless they can guarantee me absolutely massive returns?
Exactly. It acts as a massive dampener on the entire financial system. It just sucks the oxygen out of the room.
And managing this whole system is a deeply, deeply divided Federal Reserve. I mean, Jerome Powell has just been replaced by Kevin Warsh as Fed chair in a historically narrow 54-45 Senate confirmation vote.
It was incredibly tight.
And he's inheriting a Federal Open Market Committee that is just violently fracturing right now.
Yeah.
We recently saw a historic four-way descent on policy direction.
Which you almost never see.
Never.
It really highlights the severe friction between trying to tame this sticky inflation and managing a massive, just ballooning federal debt load. I mean, U.S. budget deficit is currently projected at $1.9 trillion.
Trillion, with a T.
With a T. And here's the staggering part. Net interest expenses alone are hitting $1.0 trillion.
Wait, so we are spending more just to service the debt than we are in national defense?
Yes, we are. And this creates what economists call a severe crowding out effect for private capital.
Let's visualize that for a second. Think of the U.S. government as a giant sponge sitting in a bucket of water.
Okay, I like this.
Right now, just to pay the interest on its debt, that sponge is soaking up a massive amount of the available capital in the financial system. So if you are a mid-sized private business trying to get a loan to build a new factory, you're fighting for the few drops of water left at the bottom of the bucket.
And you are going to pay an exorbitant price for those drops. That's a perfect way to look at it. The government is soaking up the capital, making it incredibly expensive for the private sector to borrow. And this real yield squeeze, it's acting as a brutal Darwinian sorting mechanism right now.
It really is. I picture the corporate landscape right now as being filled with zombie companies.
Oh, the zombies are everywhere.
Right. These are businesses whose fundamental models actually don't work.
Yeah.
But they were kept on life support by zero interest rates over the last decade. They survived purely by rolling over cheap debt year after year.
Yeah, and now they're waking up in 2026 to find their life support has been violently unplugged. The reckoning for those zombies is finally here.
Because they're staring down that massive 2026 to 2027 refinancing wall.
Exactly. They took out these 5 or 10-year loans when rates were near zero, and now those loans are coming due. They have to refinance them at today's elevated levels, and the math just does not work.
It's completely crushing them. We see vulnerable regional banks like Zion's Bank Corporation ticker Zion and legacy office REITs, the real estate investment trusts like Boston Properties BXP and Vornado VNO.
They're essentially trapped. They're holding these stranded commercial real estate assets in a high-rate environment, which is a nightmare.
Meanwhile, the financial giants who actually have the massive scale to navigate this volatility, they're doing great. Banks like JP Chase, JPM, and Apollo Global, APO, they are thriving because they have the capital buffers to just absorb the shock.
They can weather the storm.
But hold on, this raises a huge contradiction.
Oh.
If borrowing money is so punishingly expensive right now, how are the tech giants managing to spend tens of billions of dollars on AI infrastructure? I mean, where is all that money coming from if debt is so expensive?
Well, if we connect this to the bigger picture, the tech megacaps are immune because they simply don't need the debt markets.
Oh, right. They have their own cash.
Exactly. Cash-rich titans like Microsoft and Alphabet are entirely self-financing their historic AI capital expenditures. They generate so much free cash flow from their existing software and search monopolies that they are operating completely above the fray of rising debt servicing costs.
They're just living in a different reality. And they are taking that massive mountain of cash and throwing it at the biggest physical bottleneck in the world right now, which is the electrical grid.
The narrative of tech has forcefully migrated. It went from the sterile abstraction of software to heavy industrial constraints.
Right, because the binding constraint on scaling artificial intelligence is no longer computer chips.
No, it's not.
It's not about how many GPUs, graphics processing units you can manufacture. It is baseload electricity.
A modern AI data center consumes power at a scale we literally haven't seen since the heavy manufacturing booms of the 20th century. I mean, you can have all the advanced GPUs in the world, but if you cannot plug them in, they are very expensive paperweights.
So why not just plug them in? Like, build more substations, connect to the public grid, and move on.
Because the grid is hopelessly congested. There's this mechanism called the PJM interconnection queue. It basically manages the wholesale electricity market and transmission grid across 13 states in the eastern U.S.
Okay.
If you want to build a new power plant or a massive data center, you have to get in their queue for an impact study to make sure your project won't blow up the grid.
Right. You can't just plug in a massive facility without checking.
Exactly. But right now, that queue is paralyzed. They have a staggering 220 gigawatts of new generation applications stacked up.
Wow.
To put that in perspective, in Virginia, Dominion Energy is facing a 70 gigawatt shadow demand just from proposed data centers.
Oh, it's 70 gigawatts? That's, what, 3 times their historical peak load for their entire system?
Yes. 3 times. And you can't just flip a switch and magically upgrade the transmission lines. The physical speed limit here is dictated by a massive global electrical transformer shortage.
Wait, before we move on, for someone who isn't an electrical engineer, what exactly is a transformer in this context, and why is it holding up the entire future of AI?
Sure. So think of a transformer as a toll booth that adjusts the voltage of electricity. It steps it up so it can travel long distances over power lines, and then steps it down to a safe level for a building to actually use.
Okay, makes sense.
You need massive ones called generator step-up units for these hyperscale data centers. But the global supply chain for the highly specialized steel and components to build them is completely maxed out.
So there's a backlog.
A huge one. Lead times for these units have blown out to 144 weeks.
144 weeks, so that's almost 3 years.
Yep.
That means even if you get regulatory approval today, you're waiting 3 years just for the hardware to connect your power to the grid.
Which is an absolute eternity in the AI arms race. You can't wait that long.
Here's where it gets really interesting. If you're Silicon Valley CEO, you definitely can't waste 3 years. So they've essentially become nuclear diplomats.
It's wild to watch.
Because they can't wait for the public grid queue, these hyperscalers are bypassing it entirely to secure what they call energy sovereignty. So they can't wait for the grid. What's their workaround?
They are literally buying their own nuclear power plants.
It sounds like sci-fi.
It does. Amazon Web Services locked in a 1.9 gigawatt agreement directly at the Susquehanna nuclear plant. They are putting the data center right next to the reactor, taking the power before it ever even hits the public grid.
Unbelievable. And Microsoft signed a 20-year deal with Constellation Energy, ticker CEI, to underwrite the $1.6 billion restart of the 3 Mile Island nuclear plant. They're renaming it the Crane Clean Energy Center.
Yeah, and what is truly remarkable about that Microsoft deal is the regulatory maneuvering involved. They utilized a critical FERC regulatory waiver.
That's the Federal Energy Regulatory Commission, right?
Exactly. Usually, restarting a plant and connecting it involves years and years of red tape. But by using this waiver to transfer interconnection rights at the specific site, they managed to shave 4 entire years off the restart timeline.
It's incredible. The true economic moat right now doesn't belong to the software developers anymore. It belongs to the infrastructure warlords.
Completely.
Winners in this space include Constellation Energy, Vistra, ticker VST, and NextEra Energy, NEE, which is executing just a jaw-dropping $75 billion capital offensive to build out clean energy and transmission.
Huge amounts of capital.
You've also got equipment suppliers like Eaton Corp, ETN, who manufacture those desperately needed transformers. And of course, NVIDIA, driving the underlying hardware refresh cycle.
The scale of capital deployment in this sector is breathtaking, but you have to keep in mind it's happening at the very top of the corporate food chain.
Which naturally leads me to ask, if you're listening to this right now and you're hearing about multi-billion-dollar nuclear data centers and these mega caps throwing around billions in cash, you might be looking at your own grocery bill or credit card statement and thinking, why doesn't the overall economy feel like it's booming for me?
Right, and the answer is because the top-line GDP numbers you see reported on the evening news are an illusion.
An illusion.
Well, they are mathematically accurate, sure, but they are hiding a massive fracture beneath the surface. We are looking at a deeply K-shaped consumer economy.
Let's visualize that K-shape, because it's vital for understanding this. Picture the letter K. You have the straight vertical line that's the historical baseline of the economy. But then it splits. The top arm points straight up to the sky.
That is the top 20% of earners.
Right. And they are completely insulated right now. They locked in sub 3% fixed rate mortgages years ago, so their housing costs are frozen, and they are riding this massive wealth effect from the stock market booming.
And they are single-handedly floating the aggregate GDP with premium experiential spending. You know, flying to Europe, renovating kitchens, buying luxury goods.
But then look at the bottom arm of the K, the line pointing straight down into the dirt. The bottom 80% of the economy is just exhausted. The savings bridge that was built up from stimulus checks during the pandemic has completely collapsed.
It's gone. The U.S. personal savings rate has plummeted to 2.6%, which is a pre-recessionary distress level. The middle and lower classes are surviving daily life by relying on high-interest, unsecured credit.
And the distress data on that debt is alarming. Credit card delinquencies have breached 12.4%. Subprime auto loan distress has hit 6.65%.
That auto loan statistic is critical, by the way. At 6.65%, that actually eclipses the worst levels we saw during the 2008 global financial crisis.
Wow. Worse than 2008.
Yeah. Think about the real-world stakes there. A car is usually the absolute last thing someone defaults on because you need it to get to work. If auto defaults are spiking, it means that bottom 80% consumer is completely tapped out. They have nothing left.
So how does this translate to the stock market? If the domestic consumer is basically split in two, How are retailers even surviving?
It creates a very specific playbook for investors. The winners are utilizing a barbell strategy.
Meaning they cater either to the extreme top or the extreme bottom, avoiding the middle entirely.
Exactly. Amazon AMZN commands broadline dominance because their AI supply chain efficiency allows them to shelter consumers who are desperately seeking value and low prices.
And on the other end of the barbell.
You have companies like Booking Holdings, BKNG, capturing that affluent experiential travel boom from the top 20%. They are seeing a 20% surge in gross bookings.
So the extremes are fine, but the losers are the ones stuck in the middle.
Hmm.
Middle-tier retail and legacy brands are just getting crushed in this margin vice.
Oh, absolutely. Macy's, ticker M, relies on a middle-class shopper who simply doesn't have discretionary income anymore, and they're watching their foot traffic just collapse.
We're also seeing this hit the grocery aisles, right? Processed food giants like Kraft Heinz, KHC, and Conagra Brands, CAG, they are facing violent consumer price rejections.
Yeah, they tried to keep raising prices, and consumers finally snapped. People are trading down to private label store brands just to make ends meet. Plus, these legacy food companies are facing a massive secular headwind, which is the explosive adoption of GLP-1 weight loss drugs.
Wait, you're saying people are literally eating less food because of drugs like Zepbound and Ozempic, and that's actually moving the needle on corporate earnings for Kraft Heinz?
Absolutely it is. When millions of people chronically suppress their appetite, the aggregate volume of snacks and processed foods sold drops noticeably. It is a dual threat for these companies: strapped wallets and changing human biology.
That's wild. So if the American middle class isn't buying as much stuff, that doesn't just hurt local malls. That has to be sending massive shockwaves across the ocean, right? Like the factories in China making all those goods, what happens to them when the U.S. consumers stop swiping their credit card?
What's fascinating here is how this domestic exhaustion is colliding with international trade wars. It triggers a hostile realignment of the entire global manufacturing base.
Okay, how so?
Well, China was already dealing with a collapsing domestic property market. To offset that massive loss, they have pivoted to an export-led manufacturing overdrive. The Chinese government officially calls it new productive forces.
Right.
They're subsidizing massive global overcapacity in strategic sectors. Think electric vehicles, advanced batteries, and solar panels. They're just flooding the zone.
But the West simply cannot absorb a tidal wave of cheap, subsidized goods without completely destroying their own domestic industries. So they have erected a massive tariff wall. The U.S. recently levied a 100% tariff on Chinese EVs just to keep them out of the market entirely.
And because of this rising geopolitical friction and the tariffs, global capital is getting really nervous. It is actively fleeing China and finding a new home in India. Analysts are calling this the Bharat premium
Let's break that down. Why India and not somewhere else in Asia?
because of the domestic consumer. Look at the data. The HSBC India Services PMI just hit a massive 59.8.
The PMI is the Purchasing Managers Index, right? It's a survey of business activity.
Exactly. And anything over 50 means expansion, so 59.8 is explosive growth. And what's crucial here is that this growth isn't just driven by exporting things to the U.S., it's driven by robust domestic demand from India's own booming urban middle class.
Ah, so they have their own consumers to sell to.
Capital loves that self-sustaining growth, hence the premium valuation on Indian equities right now.
Back in the U.S., these global supply chain fractures mean the government realizes we can't just rely on overseas factories for critical infrastructure anymore. So they are heavily subsidizing domestic reshoring. They're paying companies to build things here at home.
Which creates massive winners in the industrials and defense sectors. GE Aerospace, GE, and Lockheed Martin LMT are just thriving on record backlogs right now.
Though it's worth noting, the industrial space still requires actual execution. Boeing, BA, remains a major loser despite the reshoring trend.
Yeah, Boeing is a tough story right now.
Entirely because they are crippled by ongoing FAA, quality control scrutiny, and strict 737 MAX production caps. It honestly doesn't matter how much demand there is if regulators won't let you build the planes.
Very true. We see a similar bifurcation in healthcare, too. Premium valuations are only going to the technological disruptors. Eli Lilly, LLY, is completely dominating with its GLP-1 weight loss assets, Zepbound and Mounjaro.
And Intuitive Surgical, ISRG, is thriving. Why? Because they make robotic surgery equipment. That falls under hospital capital expenditures. Massive healthcare networks still have the capital budgets to buy high-end technological upgrades.
Meanwhile, legacy retail players are struggling. Walgreens Boots Alliance, WBA, is facing severe margin compression and massive store closures.
Right? Why is Intuitive thriving while Walgreens struggles? It goes right back to that K-shaped consumer division we talked about. Walgreens relies on the everyday retail consumer walking in to buy toothpaste and cold medicine. And as we just established, that consumer is completely tapped out.
You also have legacy pharma like Pfizer, PFE, struggling heavily with post-COVID pipeline exhaustion.
So what does this all mean? We've covered everything from nuclear data centers to tapped out consumers and global trade wars. How should a retail investor actually process this massive restructuring without getting totally overwhelmed?
This raises an important question for anyone managing capital today.
Right.
You have to look past the broad index funds.
Right.
For a decade, the assumption was that a rising tide lifts all boats, so you could just buy the whole market and go to sleep. But the tide of 0% interest has receded.
The water is gone.
The water is gone. You have to focus on the hard physical realities of the companies you invest in. Do they have pricing power? Do they have access to electricity, period? Are they insulated from the punishing cost of debt?
That is the incredible journey we've mapped out today. We started at the top of the high interest rate plateau. We descended into the nuclear-powered AI data centers, navigated through the struggling K-shaped consumer base, fighting off high interest debt, and ended up in the fractured global supply chains where capital is fleeing to India.
It's a completely different landscape than it was even 5 years ago. And it all underscores one reality. Capital allocation now requires ruthless selectivity. You really have to understand the physical mechanisms beneath the stock tickers.
We are no longer in an era where you can just throw money at the broader market and ride the waves of cheap debt. You have to look at the physical constraints and the consumer realities on the ground.
And I want to leave you with a final thought to mull over today. We've talked extensively about these trillion-dollar tech hyperscalers bypassing the public grid to monopolize the cleanest, cheapest 24/7 baseload nuclear power available.
Right, the whole energy sovereignty pivot, leaving the transmission queues behind.
But the overall public utility grid still needs billions of dollars in upgrades to handle standard population growth, new housing, and extreme weather resilience.
Okay. Well,
If the wealthiest corporations on Earth are essentially walling off the best, most efficient power plants for themselves, who is ultimately going to pay for the remaining far more expensive grid upgrades?
oh, wow.
Are we looking at a future where the already exhausted bottom 80% of consumers are hit with catastrophic utility rate hikes just to subsidize the physical footprint of the AI revolution?
That is a chilling thought. When you play that video game or ask an AI to write an email, you don't think about the physical servers. But someone always has to pay the power bill.
Always.
And right now, it looks like that bill is going to be incredibly steep, and it might just fall on the people who can least afford it. Thank you for joining us on this deep dive into the 2026 macroeconomic landscape. Keep questioning the narrative, look for the physical constraints, and we'll see you next time.